This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Wednesday, July 22, 2026, and this is the New York pre-market. Now, let's get into it. Supermicro just gapped up 12% in pre-market trading, pulling the entire technology sector higher and forcing the Nasdaq 100 to test immediate resistance levels. But beneath the headlines, the S&P 500 is clinging to its upper quartile, while volatility remains dangerously suppressed, creating a setup where momentum and caution are locked in a stalemate. Before the bell rings, traders need to navigate a packed calendar of corporate disclosures that could dictate intraday direction. Starting right now, we have APH reporting estimates of $1.16 per share, followed shortly by AVB with a consensus of $2.80. In the financial sector, Bank is expected to report $0.40, while Banner eyes $1.47. These results will serve as the primary litmus test for commercial real estate and banking health. Apex, from a strategic standpoint, what is the single biggest variable to monitor during these prints?
It is the correlation between the earnings quality and the sector ETFs. Specifically, look at whether APH and Bank are guiding conservatively or aggressively relative to the current interest rate environment. If financials show stress, it invalidates the risk-on thesis driving the Russell 2000.
Here is the state of play as of 9:19 Eastern Time. The S&P 500 ETF, SPY, is trading at $748.28, up 8 basis points. The tech-heavy QQQ is stronger at $708.97, plus 1.85%. The Dow Jones Industrial Average, Diamonds, sits at $521.51, adding 73 basis points. Meanwhile, the small-cap-focused Russell 2000 ETF, IWM, is up 1.45% at $296.54. Sector rotation is evident. Technology, the technology sector, leads the pack with a nearly 3% jump to $180.78, while defensive staples, consumer staples, are down 94 basis points to $84.06. Let's dig into the drivers. The headline maker is Supermicro, SMCI, which is surging 12.6% to $28.71 on volume at 1.7 times its normal average. The catalyst cited is general market mover activity, but there is no specific earnings beat attached to this gap yet. Alongside it, RPM International is up 6.5% after beating Q4 estimates, and Diod is climbing 6.7% as analysts flag it below fair value. CIPHER, let's start with the giant. What does the SMCI movement actually represent for the sector?
It represents a liquidity event, not a fundamental one. We are seeing a 12% gap up on 1.7 times volume with zero concrete earnings confirmation to anchor the valuation. Compare that to RPM, which is up 6.5% strictly on a verified revenue beat. SMCI is currently a sentiment proxy. Until there is hard data on their server demand margins, this move is speculative flow chasing momentum.
And from a technical standpoint, CIPHER, that speculative flow is pushing SMCI right into a zone where it needs to hold. But let's zoom out to the tape. It's not just SMCI. The broader QQQ is pressing against $708.97, which is essentially touching the previous session's high of $710.05. Grid here. The SPY is at $748.28, sitting just $2.44 away from the July 16 high of $750.72. We are at a confluence of resistance across the board.
And that is where my alarm bells are ringing. You're talking about technical resistance, grid, but I'm looking at the sentiment data. The VIX is suppressed at 18.65. Despite the aggressive positioning in IWM, which is up 1.45%, we aren't seeing any fear-based hedging. The market is complacent. Look at the divergence inside the tech stack. NVDA has a positive sentiment score of 0.53, but Apple is dragging with negative 0.71. That internal fracture suggests the risk-on move isn't broad conviction, it's selective leverage.
Which brings us to the elephant in the room. The market is pricing in a soft landing, but the macro ledger doesn't balance. The 10-year minus 2-year yield curve is flattened at just plus 37 basis points. Core PCE is stuck at 3.41%. You have a VIX of 18.65 implying calm, while inflation remains nearly double the Federal Reserve's target. This is a momentum trap. The rally in the technology sector and QQQ is entirely disconnected from the cost of capital reality. And don't forget, the trade-weighted dollar index is strong at 120.53, which will squeeze multinational earnings in the technology sector regardless of how good the pre-market headlines look.
SPECTER, I respect the macro headwinds, but you cannot fight the tape when SPY is trading at its highest level since July 15. Technical breakouts in a flattening curve environment often fail, yes, but right now the price action is telling a story of absorption. The IWM at 296.54 is narrowing its range against the 298.21 high. That is elasticity. If we get volume, it clears.
If you clear it on 18.65 VIX, that is not a breakout. That is a blow-off top waiting to reverse. The risk is asymmetric here. You are buying strength into max compression.
Let's lock onto that resistance level for the S&P 500. SPY is at $748.28, mere feet from the July 16 high of $750.72. Grid, walk me through the structure at that specific level.
It is a binary decision point. The 10-day range top for SPY is $755.58, but the immediate psychological and structural barrier is $750.72. Right now, at $748.28, we are in the upper quartile of the 10-day range, $739.51 to $755.58. There is very little buffer. If SPY opens and immediately tests $750.72 on low volume, the probability of rejection increases sharply. The tape is asking, do we have enough buyers to absorb the sell orders sitting exactly at the July 16 high?
And here is the problem for the bulls. The buyers are concentrated. The money is flowing into the technology sector and specific names like SMCI. The broader SPY composition is mixed. You have the energy sector, energy, helping with a 1% gain, but communication services is down almost 0.7%. So SPY is being propped up by a subset of the market. When the tech bid pauses, SPY doesn't have the breadth to hold $750.72 on its own.
Exactly. And that lack of breadth is visible in the sentiment scores. If NVDA is holding up at 0.53, but the broader consumer-facing tech like Apple is at negative 0.71, the SPY bull case is fragile. Retail sentiment, which often amplifies retail index moves, is likely following the NVDA lead. If that sentiment cools even slightly, the float available to push SPY through $750 disappears instantly.
So we have a narrow bid, suppressed volatility, and a macro backdrop that hates high valuations. What happens if $750.72 rejects? Historically, when the VIX is this low and the rejection happens, it's violent. We drop back to support floors quickly. I am watching the $746.29 level mentioned in the brief. That's the support floor formed yesterday. If SPY breaks that, the risk-on trade flips to profit-taking.
I'd argue the flip happens sooner. If the first 15 minutes show SPY failing to hold $748.28 and sliding below the opening print, we don't wait for $746.29. The breakdown initiates a cascade toward the $744.18 mark, which is the 24-hour low. The momentum is currently upward, but the inertia is weak.
Let's pivot to the engine of this rally, the QQQ. It's at $708.97, up 1.85%, challenging the July 21 high of $710.05. The technology sector is leading with a 2.89% gain. CIPHER, is this rotation sustainable?
Only if it broadens beyond the hardware speculators. As I noted, SMCI is driving the index via headline volume, but look at RPM. RPM is up 6.5% on actual earnings. If the market shifts focus from SMCI gap up to RPM's fundamentals, we might see a healthier, slower grind higher. But if SMCI collapses on open, the QQQ loses its anchor. The data shows institutional flow is currently prioritizing news velocity over earnings quality in the semiconductors space.
And that velocity is burning hot. We are seeing extreme volume anomalies in low-float names like IRS, which surged 185%, and LSPR, up 132%. That is retail leverage entering the chat. When that kind of speculative heat enters the ecosystem, it creates churn. It doesn't necessarily create the steady bid needed to push QQQ cleanly through $710.05 without a pullback.
I agree the churn is a factor for longevity, but technically, the path of least resistance right now is still up towards $710.05. The QQQ is at $708.97, just $1.07 away. The 10-day high is $726.39. If we clear $710.05, the next stop is the mid-range. However, watch the volume profile. If QQQ crosses $710.05 on declining volume compared to the SMCI spike, it is a fake out. I need to see the tape match the header.
Or you are buying into a currency headwind. The dollar index is at 120.53. QQQ is loaded with multinationals. A strong dollar erodes their international revenue. You are buying tech strength while the dollar simultaneously eats into the bottom line. That is a losing equation over the medium term. The VIX at 18.65 won't reflect this until it's too late.
Finally, the surprise of the morning, small caps. IWM is at $296.54, up 1.45%, approaching its 10-day high of $298.21. Pulse, is this a genuine risk-on shift or a dead cat bounce? It looks like a dead cat bounce masquerading as a shift. Yes, IWM is outperforming diamonds and SPY percentage-wise, but look at the VIX. If this were a genuine risk-on regime change, volatility would expand slightly as uncertainty returns to the small cap space. Instead, the VIX is suppressing at 18.65. That tells me institutions are using cheap options premiums to hedge their larger positions while quietly rotating into small caps for mean reversion. It's not conviction, it's arbitrage.
From a fundamentals lens, IWM's move makes sense if we assume rates are peaking. Small caps are highly sensitive to the cost of debt. With the Fed funds rate at 3.63%, any hint of stabilization helps them. But remember the flat yield curve. If the 10-year, 2-year spread continues to compress, it signals slowing growth, which hurts small caps disproportionately, until we see confirmed rate cut expectations in the bond market. This IWM rally is premature.
Technically, however, the setup is tight. IWM is at $296.54, with $298.21 just $1.67 away. The 10-day range is $290.68 to $298.21. We are hugging the ceiling. When a market trades at the top of its 10-day range with narrowing spreads, it usually resolves in the direction of momentum unless stopped out. My read is that if IWM touches $298.21 and holds for 10 minutes, shorts will cover, accelerating the move. But SPECTER is right about the fragility. If the broader SPY rolls over, IWM will reject $298.21 harder than anything else because it lacks the institutional depth of SPY.
And that lack of depth is the danger. SPY has billions in AUM backing it. IWM has less liquidity. If the macro data hits, the sticky CPI, the flat curve, IWM gets sold off fastest. Do not mistake the proximity to $298.21 for safety. It is the precipice.
We've heard from Grid, CIPHER, Pulse, and SPECTER. Apex tie this together. We have SPY resisting $750.72, QQQ testing $710.05, and IWM nudging $298.21. What is the governing dynamic?
The governing dynamic is narrow momentum versus macro fragility. Grid correctly identifies that we are at critical technical thresholds across SPY, QQQ, and IWM. All three are pressing against 10-day highs or psychological barriers. However, CIPHER highlights that the fuel for this rally is uneven, relying on SMCI news flow and RPM's earnings, while broader sectors like communication services are weakening. Pulse adds the crucial layer that sentiment is bifurcated. NVDA is strong, but ARPL is weak, and low-float speculation, IO/LSPR, is creating noise rather than sustainable order flow. Finally, SPECTER's warning about the VIX staying at 18.65, while the yield curve flattens, means this breakout attempt lacks the volatility premium required to sustain a new trend. The synthesis is this: expect a test and hold scenario. Indices will probe these highs, but without a spike in volatility or broadened participation, the path of least resistance is consolidation, not extension.
Here is what we know as the market opens. First, resistance is immediate. SPY at $750.72, QQQ at $710.05, and IWM at $298.21. Second, the rally is narrow, driven largely by the technology sector and specific names like SMCI, while the broader market shows mixed signals in communication services and consumer staples. Third, the VIX remains suppressed at 18.65, suggesting that any breakout attempt is fragile and prone to rejection if volume dries up. Tomorrow, keep an eye on how these indices react if they fail to clear these levels. Will they consolidate, or will the macro headwinds force a deeper pullback? This is ShadowQuant Equities Edition. Thank you for listening. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.